BNPL, neobanks, and embedded finance. What's really going on? You're buying a $120 jacket online. At checkout, you see, pay in 4 interest-free installments. No credit check. No paperwork. Just tap and it's yours. Feels like free money, right? But here's the truth. Nothing in finance is free. Someone's always paying. And too often, it's you. Welcome to the new world of digital payments. Buy now, pay later, mobile-only banks, and finance baked into your apps. Let's break down what's actually happening and what it costs you. First, buy now, pay later. Services like Klarna, Afterpay, and Affirm have exploded among Gen Z. They feel painless. No interest if you pay on time, no hard credit pull. But late fees can hit $7 to $10 per missed payment, which adds up fast. Missed 2 payments? That soft credit check turns into a collections report. The BNPL charges merchants 4 to 6% per transaction. That cost gets baked into prices. So even if you pay cash, you're still subsidizing BNPL users. Second, neobanks like Chime, Revolut, or N26. They promise no fees, instant payments, and sleek apps. And they deliver. But fee-free often means revenue from interchange fees. Some earn money by lending your deposits to hedge funds. And overdraft protection? Sometimes it's just a high-interest loan in disguise. Third, and most invisible, embedded finance. That pay with PayPal button? The financing available option on Peloton? The savings account inside your Uber app? Finance is no longer something you go to. It's something you stumble into. And that's the genius and the danger. Because when money becomes frictionless, spending becomes thoughtless. Studies show people spend 15 to 30% more when using BNPL versus debit. Why? Your brain doesn't register it as real spending. But the bill always comes. In part 2, we'll expose the hidden costs, late fees, data privacy risks, and how free apps profit from your financial behavior. Stay with me.
Hidden fees, data risks, and the illusion of free financial services are more prevalent than ever. Let's talk about the fine print, because that's precisely where the real cost often hides. Consider buy now, pay later, or BNPL, late fees. On a $100 purchase split into 4 payments, miss just one? You could get hit with a $7 fee. Miss another? That's another $7. Now you've effectively paid 14% extra on a loan that was initially supposed to be interest-free. Unlike traditional credit cards, many BNPL providers don't cap total fees, meaning they can accumulate indefinitely. In some states, you could even end up paying more in fees than the actual item cost itself. Then there's the critical issue of your personal data. When you sign up for a neobank or BNPL app, you often grant them extensive access to your entire transaction history. Why do they need this? Ostensibly, so they can personalize your experience. However, that same data is also used to sell ad targeting profiles, allowing companies to reach you more effectively. It's used to price discriminate, offering different deals based on your specific spending habits. And even to predict your financial vulnerability, potentially leading to targeted offers when you're most susceptible. One major BNPL company was actually caught tracking users across over 200 shopping sites, even after they had logged out of the app. What about embedded lending? That enticing $0 down, 24-month financing offer on your new laptop? It might actually come from a partner bank with a hefty 19% APR, buried deep within the terms and conditions. You might think you're getting an incredible deal, but in reality, you're signing up for high-cost debt. Even seemingly free checking accounts come with their own trade-offs. Chime, for instance, makes money by strategically delaying direct deposits and investing that flowed overnight. Revolut earns from currency exchange markups, often 0.5 to 1% above the market rate. These practices aren't illegal, but they certainly lack transparency, making it harder for consumers to understand the true cost. And here's the most insidious psychological trap. When everything feels instant and seamless, you stop thinking like a CFO. Instead, you start thinking like a casual shopper. You no longer ask, "Can I truly afford this?" You simply ask, "Can I fit this into 4 convenient payments?" But remember, debt is still debt. whether it's on a traditional credit card or a cheerful pink Klarna notification. The real cost isn't just measured in fees, it's also in lost financial awareness and control. However, it's not all bad news, because some of these digital tools, when used wisely, can actually improve your money habits. In part 3 of our series, we'll show you exactly how to harness digital finance without getting trapped. We'll also guide you on how to spot the services that truly prioritize and put you first.
Welcome to Smart Strategies, where we explore mastering digital finance without overspending. Digital finance is a powerful tool at your disposal. Its effectiveness depends entirely on how you use it. How do you maintain control and use these digital tools wisely? Rule number 1. Treat buy now, pay later, or BNPL services like a traditional credit card. Only use BNPL if you already have the full amount saved and available. This allows convenience without unnecessary financial risk. Always link BNPL payments to a calendar reminder to avoid missing due dates. Rule number 2, meticulously read the fee schedule for every new financial product. While neobanks advertise no monthly fees, dig deeper into their terms. Check for ATM withdrawal limits, international transaction markups, or inactivity fees. Transparent banks like Ally or SoFi clearly publish all fees up front in plain English. Rule number 3, actively opt out of data sharing in your financial apps. Navigate to app settings and disable personalized offers and transaction analysis. Yes, you might see fewer. Rule number 4, utilize embedded finance features, but be aware of their true purpose. A savings account in your Uber app is fine if it's FDIC insured and offers a competitive interest rate. However, if it's just a gimmick to keep you engaged, skip it. Here's a pro move. Consolidate and track all your digital spending in one centralized location. Whether you use apps like Monarch Money or a simple spreadsheet, consistency is key. Fragmented money across multiple apps prevents a comprehensive view of your financial health. Now, let's consider the future. Embedded finance is an undeniable trend that will only expand. Soon, you might find microloans in TikTok Shop, insurance in Airbnb, and retirement plans in your payroll app. This evolution could be beneficial if services are built with transparency, fair pricing, and user control. However, currently, the system often rewards impulse decisions over thoughtful financial intentions. Protect your financial attention as if it were pure gold, because its value is truly immeasurable. Before every tap or transaction, ask yourself, am I paying for convenience or contributing to someone else's profit? The most powerful financial tool you possess isn't an app, it is your own awareness. If this discussion helped you view digital payments in a new light, please hit subscribe. We break down complex topics related to money, technology, and hidden systems shaping your wallet every week, with no jargon. Thank you for watching and for investing your time in understanding your financial future.